Hello and welcome, everyone. Thank you so much for joining us for our State of Freight webinar presented by TruckStop. I'm Julia Becker. I'm the Vice President of Media Operations here at FreightWaves, and I'm joined by Craig Fuller, our founder and CEO, and Zach Strickland, our Head of Freight Market Intelligence. We have a great session for you today, but before we get started, I want to cover just a couple of quick items. If you have any issues during our webinar, you've got that audience chat box in your console. You can reach out and get in touch with us. We're also going to have live Q&A at the end of our discussion, as always. So remember to submit all of your questions that you have, and Craig and Zach will answer as many questions as we can at the end. I'll also be sending a link to the recording of this webinar if you want to watch it again or share it with your colleagues. Now I'll go ahead and turn it over to Zach to kick us off.
All right, and thank you for that, Julia, and thank you all for tuning in on this Friday, or however or whenever you are viewing our State of Freight webinar for the month of March. Craig, I think there's still that term floating around in the air. Tariffs continue to dominate the economic headlines, the political headlines, and I think subsequently the freight and transportation headlines as well. We have an entire section dedicated to it on FreightWaves.com for just that reason. And I think we'd be remiss if we didn't kind of lean into that for this episode and really talk about, we've got some data that helps us kind of anchor ourselves. I know I personally look at some of these data points to you get lost in these headlines. It's mentally exhausting. I have not read enough. There's no one way to kind of digest all of the complexity in this. You can have arguments for both sides, good and bad. And it's really, really hard to get through, but we can lean on what is. And the data that we're going to show today helps us kind of anchor that in what is happening today as much as we can speculate on the future. What's your take so far? I mean, we talked about tariffs a couple of times over the last, obviously, few webinars, but I'd like to get your read on the current environment right now and what necessarily was different from your expectations.
Yeah, I would say the word floating is a complete misnomer. You said the word tariffs are floating around. They're not floating around. They're like on top of us. Gravity is weighing us down. It's all about tariffs. And I think that is the primary theme of everything we're going to talk about today is largely related to what's going on at the government. And so you have to, if you sort of understand the freight market, you have to consider tariffs. And let's talk about what's different. So in early November, all the way through the end of the year, and really through mid-February, it's really Valentine's Day was the day when everything felt like it was changing. You could see it in the data. That was a pivotal moment in the freight market and in the economy where tariffs felt like they were starting to become very real. We had a couple of things happening. We had the tariff threats on Canada and Mexico that were sudden. You had the Colombia threat, which turned out to be quickly withdrawn because Colombia was willing to accept American flights of immigrants. And so a lot of that has been hanging out over the freight market. It's now shown up in the financial markets. We've seen the stock market sell off aggressively. And what we've seen is a change of it. But let's talk about why things are different. So in early November, I came out and said the freight recession was over with. And I think that's absolutely true. Is the freight recession as defined by the Great Freight Recession, which is where you had too much capacity in the market relative to demand, that cycle was over with. And I still contend that that's the case. But I also would say that you have a solid argument that the freight recession is coming back, this time a very different set of circumstances. It is not a capacity question any longer. It is an economic question. And you and I said multiple times over the last 2 years, and certainly even when we talked about the freight recession happened, if you go back and play the tape, I wish we had the handkerchief, we could throw the tape.
The roll.
And go back and see it, is we said if the economy slowed down, and there was a big change in the broader economy, that would change the thesis that we have. And that's exactly what's happening. Is this off and on again tariff situation is causing enormous amount of stress of supply chain practitioners. And I think everyone, including us, talked about Chinese tariffs. I think it was a foregone conclusion that there would be Chinese tariffs. I also think there was a foregone conclusion there would be other tariffs to other parts of the world. What I didn't understand and didn't appreciate was that tariffs would be, the very first set of tariffs would target Mexico and Canada. And Donald Trump is willing to rip up USMCA. And I think what I expected was that there would be a renegotiation of USMCA. I didn't expect him to come so hard at Canada specifically. Mexico too, I mean, I think there was an expectation that something may happen with Mexico, but not to the extent we certainly have seen it. And I think that's a very different story than I had certainly expected coming into it. So if we got it wrong, is that we miscalculated Donald Trump's intentions and his view of the North American trade. In fact, if you go back and look on X, because I had tweeted a lot after the election, my prediction was that Laredo was going to become the epicenter of North American trade, and Mexico would be the primary beneficiary of Donald Trump's economy.
I think most companies did.
Absolutely.
We were seeing this in the data.
You look at USMCA, NAFTA 2.0, and that was a Donald Trump trade policy, something he was quite proud of when he first did it in his first administration. And while he's talked about the fact that it needs to be renegotiated, I didn't expect, and I think many people didn't expect him to be so adamant that it needs to be done so quickly. And basically using fentanyl as a primary message, whether that's true or not. And I certainly use a case of fentanyl. And it's a tragedy. I had a family member who died of a fentanyl overdose. So I recognize the tragedy that is, but I think this is a much bigger, obviously with the auto tariffs that have just recently been announced a couple of days ago, this is a much bigger story that relates bigger than, I think, fentanyl and immigration.
Yeah, and I think, in a lot of my research, I alluded to the fact that it's hard to tell what's happening with anything immediate because we really haven't had that much implemented and has stuck. A lot of what has happened...
We've had a lot of threats.
Yeah, what has happened thus far has been a shift in expectation. And in that, we're looking for changes in behavior before the actual impacts of the tariffs and whatever other policies come into play.
I mean, I think what we have forgotten and is they are who they said they were. You know that line, the NFL, I think it was one of the NFL teams, the coach goes, they are who they thought they are. It was exactly what we've seen is I think perhaps we had forgotten that in a Donald Trump administration is you're getting what he's, we're always sort of underestimating and I think particularly this time around, the speed and veracity. And I think a lot of folks in financial markets thought that he was going to be very sensitive, that he would take direction from the stock market, that if there was a lot of concern from CEOs or a falter in equity markets, that he would soften some of his stance. We haven't seen it. In fact, he's been very convicted in the belief of tariffs. These auto tariffs are quite concerning, frankly, because, again, going back to what we got wrong was the Mexico and Canada trade. And I think if you're going to rebuild domestic manufacturing, your component and raw material suppliers in Mexico and Canada, which provide that, particularly in autos, are primary sources. And so you can't decouple that. And that's the challenge, is that the speed at which we're seeing these tariffs be implemented isn't giving a chance for companies to sort of catch their breath long enough to actually do something about it. I mean, we're talking about supply chains, particularly auto supply chains, taking years to reposition.
And automotive is a huge component.
It's an enormous, I mean, I think we've estimated as much as 8% of the truckload markets in auto and auto suppliers. Others have said that number's bigger. I think 8% is a number I feel comfortable with. Somebody said it could be as much as 15%. I think 8 is a very comfortable number if you look at the historical data. And so taking that big of a swath out of the economy feels like something that's pretty concerning. And I think there's a bigger question about confidence. Like the biggest question that I think is on the mind is not just the fact that there are tariffs coming, because I think people expected them. Even if you believed that there would be North American tariffs, you certainly didn't believe it would be fast. The problem is we don't have real good guidance. Like, we have Liberation Day, as Donald Trump has declared on April 2nd. we don't even know what that's going to be. Like he's talked about the fact that it will be
15
tariffs,
countries.
We're unsure what
Yeah.
those look like. And even a couple of days ago when the auto tariff conversation, press conference was supposed to be at 4 o'clock in the afternoon. It was delayed by an hour and a half. I remember sitting in my office with Bloomberg on TV watching for that announcement, and everyone was talking about how uncertain they were on what was coming. And I think that's the part that I think is really frustrating to a lot of CEOs, is you just don't know what's actually coming down the pipe.
Yeah, 100%. Most of the people that I talk, the companies that I talk to, they're basically just uncertain on how to behave because they don't know what's next. They're caught in the middle ground of, you've got your customers that you have to serve. That demand forecasting capability has eroded because customers are now uncertain on what their situation will be financially, economically, et cetera. And then you have this upstream component in supply chains where they're not sure where to procure their materials. And
you don't know what's going to hit.
So you've got this double-sided uncertainty that these companies are now sitting with. And I think that's what has changed a lot of the sentiment from what I've seen with CFOs for sure. They're worried about recessions more so than the economists are. But the economists have started to come around and say, okay, there's weakness, but there's not enough here to really drive a real strong call.
Look, I'll say that this has been a time where if we have been wrong, this is probably the time that we should be called out. There's been times I misunderstood how uncertain we would be about Trump's policies.
Well, I want to give you a pass. I want to give you and myself a pass here because the people that do this on the daily and look at data more than us, the stock market, the financial market.
Well, you're talking specifically people who study politics. I don't think addressed it, but
they completely missed it.
I certainly didn't expect. I think miscalculation, misunderstanding was Mexico and Canada being a primary target. The 51st state. I mean, if you've met any Canadians, they're very proud people.
Sure.
And I remember going to school in Hong Kong, and we had some Canadian kids that were there, and they were insulted if you called them American. If they were on the street in Hong Kong and you called American, they're always this sort of like they have an edge to them. About, hey, we're proud to be Canadians. And I think when you sort of take that out, that's just a distraction. I think fundamentally, tariffs I think when we talk about national security reasons against China, I'm fully on board for Chinese tariffs. I think that there's an enormous amount of support for that among the American population. There's an enormous amount of support, I think, among businesses recognizing that we need to bring manufacturing back to the Americas. I think the mistake is the word Americas versus America that I made, certainly, and I think others perhaps did as well, that we misunderstood that this was not a North America story, but it is a United States story. And I think that's the biggest challenge.
Yeah, it's definitely changed. So I want to go to the data for the first time here. Pull up the OTVI the chart here. This is our outbound tender volume index. It measures transportation requests from shipper to carrier. Some of these are accepted. Most of them are.
Zach, I want to point out a couple things in this chart.
Yeah, go for it.
We had some winter weather, so there is a little bit of noise in the OTVI data.
Yep.
But I think what you see is that sharp change in February and then that even greater drop in the second half.
Yeah.
That is when we saw a lot of so you had the inauguration, you had a lot of enthusiasm coming in really to mid-February, and then you saw this, you're starting to see this just like, we don't know what's next. And I think that is the part that's causing an enormous amount of stress among CFOs. Look, I run. Not only do I run FreightWaves and SONAR, but I also have a media business, which we sell advertising to. And I think it is hard to forecast right now. It's hard to forecast for our advertisers. It's hard to forecast even our own business because you are on edge, not knowing what is next. What parts of our business, what parts of our customers are going to be impacted by this tariff situation, and if they're impacted, does that mean that we need to lower our forecast for those particular customers? There's so much like indecision right now because you don't know. So I'm taking with our business the most conservative approach because like we have a lot of boat magazines and airplane magazines, and if those at some point become prone to tariffs, then the aircraft manufacturers and the boat manufacturers are going to be subject to those things. And therefore, you're assuming, if you're in my shoes, that we need to down our forecast. We need to look at the worst case scenario. And I think on our marine titles, we've taken a 20% drop.
Right.
Not in reality. We've been beating our numbers, but we've budgeted a 20% drop just in case, because we don't know.
Right. Yeah, it's forced a lot of companies, not just ours or everybody, into a reactive state. You have to be reactive, less than proactive, because you just forecasts are almost
look
immediately
if
foregone.
the administration wants tariffs, I think a lot of people would applaud it, including myself. You need two things to make that work. One is you need to know what the policies are.
Right.
Become very clear as to what your intentions are. And then you need companies, which again, misunderstood, you need companies a chance to actually do something about it. Like if we wanted auto tariffs, then, which we do apparently, then you need to give auto companies at least a year to figure this out. So why not make it a firm date 12 months out, let them reconfigure their supply chain, because then at least they have the chance to do that. It almost feels like that's not the goal.
Right.
It feels like there's almost like chaos coming, but no real certainty as to what the actual outcome.
I think that's been most of the criticism, has been the lack of clarity around the policy itself. Like if you were to say, hey, I want a 15% reduction in fentanyl crossing the US-MX border in the next month, that's a target that, agree with it or don't, there's now something out in front of these businesses that they can deal with and can kind of start to kind of formulate a plan around, and that's just not happening.
Like tariffs on Mexico and Canada, fine.
Yeah.
Give the auto companies 12 months.
Yeah.
Say, look, on effective January 1st,
does not change overnight.
2026. What's that?
Infrastructure cannot change overnight.
On January 1st, 2026, we're going to have a 25%, whatever the number is, 25% tariff on all automobiles into the United States that are not produced here. At least I have if I'm an auto company and a supplier, I have a year to figure that out. Now that is, by many people's definitions, too short of a time. But at least I know it's coming and I can plan accordingly. And I think that's the big rub, is that we don't know. And I think this is the part I got wrong, which was misunderstanding, again, Mexico and Canada, and what is the rule? Like, what's the law? There is something that I think has been missed, though. There is a little bit of sort of shining answer here, which is in the White House's memo that they sent out with these auto tariffs. They did mention that USMCA goods are exempt until the Department of Commerce can come out with a ruling as to it. And I have a thought here, and we've had this conversation about de minimis exemptions. There is an argument that politically the Trump administration wants to come out and say that they are anti-de minimis exemptions, which they came out and said, you can't use the de minimis exemption, withdraw it, and then they, like a day later,
Immediately pulled it back.
They pulled it back. And there was a conversation, did they win? Did they get the benefit of doing that without having to sort of soften their ground? There is an argument that that has been sort of circulating in some of the folks that study this stuff, is that there is a potential that the Trump administration is able to win huge victories publicly, but then have the fine line that is sort of understood by insiders but not understood by the broader public, that perhaps USMCA is still, like, they're not actually going to put. This is the problem. We don't know. They're not actually going to put it. But there was something interesting about that, is that at least until the Department of Commerce comes out with a rule on how they're going to enforce it, that the USMCA products will be exempt from that. So I just thought that was an interesting side.
But like you said, here we are. We still don't know.
We don't know.
So from a demand side perspective, I want to pull up a chart that, we talked about the OTVI. You saw it was pretty strongly down year over year. We're about 8 to 9% down on tender volume. So that's the truckload market, van, reefer, flatbed, et cetera, involved in that index. I want to pull up the combination chart of tender volumes with the loaded container volumes, because we find ourselves in a situation where a lot of shippers, due to the tariff concerns and pull forward, we've had this huge flood of imports coming into the country. It's very easy to throw those containers right onto the rail, especially when they don't need it tomorrow.
It's moving warehouses.
Rolling storage, as we've talked about. This has been a trend that we've been tracking since the middle of last year, and it's only persisted into this year. So the chart you're looking at right here, the loaded container rail volumes in white, and then the OTVI is in the blue. Now, the rail container volumes, Craig, have been relatively offset. The loss in truckload tenders has been relatively offset by the growth in intermodal until just recently.
Yeah.
This has been kind of my anchor for the demand side, because I'm looking at consumer demand. The surface transportation tends to fall before the import volume does in the post-pandemic era. So I'm watching this to see if there's any potential weakness showing up. And I'm starting to see, you see there's a 5% growth in intermodal right now on this chart, year over year, and a 9% decline in tender volumes. These have been somewhat hovering about a 5-6 up, 5-6 down area until the last month or so.
I'm telling you, it is Valentine's Day is where I think a lot of companies started to rethink that the tariff situation is unpredictable.
Right.
And I think that's all we're talking about here. It's not that tariffs are bad. It's not that tariffs are good. I largely was supportive of Trump's messaging around tariffs, largely because to me it felt like a China story more so than an American story. But I think the bigger part of it is just get some certainty out there.
Right.
Give businesses a chance to plan and understand what these rules are going to be. And then the great thing about our economy is smart people will figure out what to do with that.
Right.
It's the uncertainty which is causing an enormous amount of stress. And I think that's why consumer confidence is down.
Right.
I think you're starting, there have been some amazing things that have happened. We've seen Hyundai come out and talk about they're going to invest $20 billion. We've seen Apple that's bringing back manufacturing. So we're seeing these big investments announced by companies that are measured in trillions of dollars of capital investment in the domestic economy. These are huge victories, and the Trump administration should get an enormous amount of credit for helping drive those changes. What we are asking for, what I think the supply chain wants, is certainty and knowing where this is at. And I think what you're seeing in this data is that there's been a drop-off. Yeah. And I think as we think about what that means is, let's go back to the conversation about the freight recession, because deservedly so, I'm getting a lot of heat over this call, right? The freight recession's over with. Fair. Okay, I admit that perhaps that call was premature, but I do believe that the thesis that I had at the time, and I'm not ready to throw in the towel that the freight recession isn't in a recovery. I'm going to explain why. But I will contend that I miscalculated or misunderstood Trump's goals with tariffs and where it was headed. What I would say is, if the thesis about what drove the freight recession was excess capacity, I think that is, and you can look at it in OTRI data, which you've got, thank you for pulling this up. In the OTRI data, you can actually see it, is tender rejection. Can we pull up the tender rejection data, guys, backstage? The tender rejection data, you can see that it is reacting, it is actually showing very strong reaction.
This is very different from the demand side indicator.
Look at the collapse last year that happened in tender rejection. So carriers are getting some level of power over the market that they haven't had in a couple of years. Even though we have faltering volumes, what this data is telling me is that the capacity situation is more balanced than it's been.
Right.
And what caused the freight recession to plague us for the last couple of years, that period of history is over with.
Right.
Now, what we're dealing with is something completely different, which is a broader economic issue, which we have not had a massive problem with for the last couple of years, at least since 22. We haven't had the slowing of the U.S. economy. What we're dealing with right now is a broader slowdown, but it is, I think, encouraging from where I sit that the capacity map is actually balanced.
Yeah, if you weren't going to ask for this, I was going to argue for you, which...
I think it's important that we have to hold ourselves accountable to where we got it wrong, and I think it's fair to say that call was either premature or I would argue that based on the conversations that we had at the time, it was largely based on the fact that capacity was the overabundance of capacity has gone away.
Yeah, and we should clarify, tender rejection index, for those of you that aren't familiar, we can't assume that you know what this means. For sure, look it up on gosonar.com if you want to get more detail. But It is the percentage of loads that are being rejected by carriers from their existing shipper customers. So the higher this index goes, the less available capacity is. Carriers do not like to turn down freight from their customers. Freight is their lifeblood, especially at pre-existing rates that they have under contract. So what you're looking at here is an increased level of volatility and responsiveness in the market that has, it looks like, little to nothing to do with demand side conditions.
It's totally
in
just
aggregate.
it's disconnected, and the interesting thing is it has been disconnected for the last couple of years. But on the other side of the equation, is that the tender rejections were collapsing, even while volumes were slowly marching up, right? And I think what we're seeing now is that tender rejections and volume are actually operating on entirely two different axes, and as they normally do, but like they're operating almost in two different universes. And what I think this is like, let's find some encouraging words here for our friends that are hauling freight. Is that what's encouraging about this is that the capacity glut, at least as far as I stand, is largely gone. And I think what we have to sort through now is a demand question. And that should cause some anxiety for the market, but also is something that is perhaps, I wouldn't say easier to deal with, but it means that we're not dealing with a capacity situation. And this becomes a much broader economic problem. And while that's challenging, in some ways that's good because it means that you have a much bigger set of forces that potentially could address it. You have potentially the Federal Reserve could come in and potentially cut interest rates if things get really challenging. Perhaps the Trump administration will give us more clarity as to what they intend to do.
Tax incentives.
Tax incentives will certainly come. And there's a lot of things to be bullish about. I mean, there is another argument that a lot of this is just, let's get all the problems out of the way really quickly in the first part of the administration. And then the second part, we can come back with all these incentives like tax cuts and bonus depreciation, things like that, that will drive the recovery. So there is some, it's create chaos to then create solutions. Who knows?
The tender rejection index has been one that I have pointed to several times to our transportation service provider friends out there to say, look, the transportation sector has been in a recession for a long time. It's going to be a little bit more resilient to an economic downturn than many other sectors because
it is. I mean, the excesses are gone, and if you look at where we had been, and Zach, you called this almost 30 years ago, is that I think you actually had an article that you were getting a lot of heat over.
It's not unusual to get heat on the internet.
But I think you were actually saying it would be April of 2025 before the market, the capacity, the excess would leave. Like, this is April of 2025, practically.
A couple of days.
And we are now seeing that actually play out.
I mean, that was a linear regression that I used, and I was basically saying, look, if things were to progress linearly, which they never do, that's how long it would take at the current rate of decay in the transportation sector to get through it. And
we're here. And we're seeing that. That is example of and this is what you would expect to see, is where you have a lot of volatility happening inside that band. But I think the fact that we're at 7% rejections, which we didn't see hardly at all last year, actually up until the end of the year.
Yeah, that is a very high and we haven't had a March, and I actually was talking about March being kind of a triggering month, not because of tariffs or any of that.
Seasonality.
But seasonality. We tend to see spring volumes return. You get a lot of home improvement projects. It's grill season. It's mower season. All this big equipment starts to get moving, fertilizer, et cetera. The southern tier of the country, a lot of the drive in this rejection rate increase has come from the southern tier of the United States, which is on schedule. So, I mean, even though, and this is occurring with an 8% decline in demand. So if we hadn't had intermodal kind of sweep in last year, we would probably be talking in a very different way. You would not be getting any grief on the internet about, calling the end of the
recession. I'm sure there's a lot of grief, but that's not my concern. My concern is I think what we can take from this is that the freight recession, what caused the freight recession to really hang out as long as it did, that part of our story is over with. And I think we can take some refuge. There's an interesting thing you talked about, because housing construction is a big piece of the economy and housing movement. Housing starts are nobody's building homes these days. Like, people are finishing homes. But even locally, talking to some builders, there is, I mean, it's happening in pockets in the South, but generally across the country, home building is just not happening. And the reason is that like there's economic uncertainty, but one of the things that isn't being talked about is the labor force.
Right.
Is the deportations on immigrants is actually causing farmers to not have folks in the fields to the degree they want to, people building homes.
Right.
Those things are actually also hurting some of the other economic projects that could be there because of labor issues.
Yeah. And these are all things that are going to manifest out over a long stretch of time.
Now,
it looks
I
like.
got to ask this because I think we're going to talk about it, is inflation. So
big indicator came out today.
There's a big question about inflation. Well, it was up slightly, right?
Slightly,
like
0.1%. But I think the takeaway here is we've been hovering at about 2.5%.
It certainly did not fall down. So Trueflation is a high frequency data set that leads the overall inflation number, the data that comes out
Right.
By about a quarter out. Trueflation's number is actually about 1.4%, I think was the number. And there's a high correlation to Trueflation on a time shifted basis. And what it is actually showing is things like oil prices being so low and other things happening in the economy, that perhaps what we're seeing is lower inflation, not because largely driven by lower oil prices, lower energy prices, things like food prices are dropping. There is an argument that the tariffs may not, now take autos off of it because there's a whole question about what happens to auto prices, but general inflation may not, that in some ways destroying demand actually may benefit lower inflation. We could see a situation where there's lower inflation because demand across the economy has dropped. I mean, just the federal government employment picture is going to ease some of the labor market conversations.
Yeah, one of the things that has occurred also that we need to talk about outside of our borders here, rates on the ocean have dropped.
Yeah.
So transportation rates outside of America, they're falling. That also is deflationary.
It is deflationary, but
and they've fallen dramatically.
Ocean container prices don't have an enormous impact on the overall inflation number for consumers.
But my question was going to be, is there anything else kind of outside of our sphere here, immediate sphere, that you can see that might help kind of pull back?
I think energy is the thing that I would look at. I mean, one of the oil prices are in the mid 50s, which I think is largely good for the economy. There is a deregulatory stance. There's a drop in federal employment. We've seen a number of the agencies are doing mass layoffs.
Right.
Big numbers, like, you're talking 10, 20, 30,000 in a swath. Like, these aren't small numbers. And all of the services that serve the federal government, because it's like a 2-to-1 ratio of people that work in the federal government versus people that are actually serve the people that work in the federal government. That actually will ease some of the labor cost, because while we are maybe losing some immigrant population that may have not been deported but are happen to just not show up because they don't want to get deported, some of the jobs that you see in government as they lay these people off will find opportunities in the private sector. I think that's largely positive. So there's reasons. I actually don't think where I stand today that inflation is going to be the risk here. Now, I know we did see a tick today, but I think over the next couple of months, it would be interesting to watch to see if inflation becomes the risk that it was predicted to be. To me, the bigger risk is the demand side.
So on the demand side economics, like we've been looking at IOTI, the inbound ocean TEUs index, for several months now to see if there's any indication that shippers are slowing down. And
I don't think they are, and I don't think they will.
It looks like they're just continuing to
flow product in.
Inventory.
So the question is, if you're asking this without knowing a bunch of the details, why is ocean container prices dropping while demand's there? And it's all the amount of capacity, ocean container capacity that's been put on the market.
We actually thought this would happen last year.
We in terms of drops in prices, yeah, but I think we had this massive surge in demand because of the threat of tariffs.
Right.
And I think what we're seeing now is the biggest problem, Zach, goes back to what we've been talking about, is the answer used to be, hey, I'm going to move my production from China to Mexico. That seemed like a pretty obvious answer. It's the one that I would have argued and believed it. And that doesn't seem like it's going to help you very much.
Right. Is there an offset or anything you see here that says, you know what, have we put an actual almost pause on that maneuvering?
I think, look, this is a part where I would say my frustration, and anyone who's tuned into this would say this is a different tone than Craig's had for a while, right?
Yeah.
Like I've become pretty anti what the administration is doing. And I think it's largely for two reasons. One is give us some certainty.
Yeah.
And give us a chance to respond to what you want to happen, which means give people time and supply chains time to do it, and also give us some certainty as to what it is. And I think, and I would also encourage, but I don't know that it matters, that Mexico and Canada are sort of left out of that. Because if you're going to rebuild manufacturing, you need suppliers coming in. Like we don't have enough available exploitable raw materials, largely due to regulations in the U.S., which have to be dealt with. And we don't have all the labor that we need in some of the lower cost component manufacturing that you would see in Mexico because the cost of labor is higher. And so, like, if you really want to build manufacturing, like, let's go with the NAFTA region being sort of hands off.
Right.
But even if you said that was forced on us, then give people time to catch up and give us some certainty. That's what we all ask.
Just tell us
that
what
is
you
where
want.
I've diverged sharply from where my tone was 2 months ago. Is those are my personal frustrations that I think is causing an enormous amount of anxiety in the economy.
Yeah, and I don't think that's not a political statement or anything like that. That is simply just stating like what is kind of a flaw in this necessary messaging.
I know it's an art of the deal thing, and like uncertainty is an art of the deal. It does not help the economy. It doesn't help the supply chain.
No, that in business, I think this is where
certainty is important.
Certainty is important, and you need to know if you're negotiating with somebody. If they don't know what you want, it's hard for them to respond with anything. I want to talk about rates a little bit here, but first, I forgot I put this in here because I wanted to talk about another component of the demand situation. So the truckload market itself, and I've talked to several people about this, growth in short haul volume. So freight moving less than 100 miles. This is fulfillment freight. This is drayage. This is it's very far upstream and very far downstream freight. We've seen supply chains really shrink that last mile quite a bit. We've been seeing this deterioration of the middle mile in supply chains in domestic North America. This chart right here is showing us that we're seeing this continued kind of level with the short haul volumes in yellow, and the long haul volumes have almost collapsed. My question to you, Craig, is with the growth in intermodal kind of taking this component over, are we going to see, because I think for the freight recession, and many people out there to really feel the difference, that long haul figure is going to have to start ticking back up.
Yeah, you'd want to see that.
Yeah.
You'd want to see that recover. I think to your point, what we're seeing now is a lot of this stuff is in warehouses. It's been warehoused in. It's been shipped in over the course of the past year. It's been sitting in a warehouse and distribution centers, or perhaps using intermodal, railed across the country, and that's why that has not dropped off.
Right.
It does tell us something. Let's find a positive in here because it does tell us that the fact that there is. What we're seeing is a drop in the upstream part of the demand curve in the supply chain, largely because people are uncertain about what to order. But we've not yet seen the consumer.
Right.
Like if you look at this data, the consumer, that's why that short haul is still pumping.
Relatively high.
And I actually think this is an interesting data point that probably, if you're looking for a chart of the week, this is a really one, is I would argue that the consumer, while there may be concerns about upstream to the consumer and potentially longer impacts, is that at least as it relates to that short haul data, it doesn't suggest that we're seeing a sharp decline in consumer demand.
Right.
That is a positive. And I think this data to me does create a counterbalance to some of the anxiety that perhaps is there.
I agree with that take, and I was hoping you would say that. So we would be remiss if we didn't talk about rates to an extent, and arguably rates have
Can we
been...
talk about flatbed?
We can talk about
because flatbed is like we need good news today, Zach.
All right. All right.
Flatbed is good. Can we talk about the flatbed rejection data, what's going on in the flatbed
market? Want to talk about rejections? Well, I
want to start with flatbeds. Right. There's a storyline on the rate versus flatbed rejections, but I think let's set the tone here for a second.
Flatbed rejection.
Let's pull up this, if the folks backstage with production could show this chart.
Rejection rates by mode.
On the rejection rates.
Yeah.
There you go. Okay, see that purple line right there?
Yep.
That purple line is a 40% rejection rate for flatbed. Look at that. Yeah. That's a beautiful thing.
What's driving it?
It's that's beautiful. We'll tell you why this is not as beautiful as what it could be. This is, we've been, with our beer goggles on. You wake up the next morning and realize that maybe it's not as good as you want it to be. Yeah. Rejection rates are really high, largely because people are pre-positioning for tariffs. So this is Canadian lumber, this is steel and aluminum. This is stuff that is basically shifting, and it's either, it's been transported, but it's also in some ways could be, in some ways, these roving warehouses we've talked about is getting it across the border as fast as possible. Let me get my hands on every flatbed I can possibly get, and then I'll deal with it. And so I think that's what's driving this.
Yeah. It's transitory.
It's transitory. Thank you, Jay Powell, for that term. Yeah. It is literally transitory because it's being in transit. Yes, that's a good joke. Look at refrigerated. Dropping off. Look at
but not as bad as it did last year. I've talked to several refrigerated service providers out there that they're talking about actually being in a relatively okay position. Now, new sales, not great. Yeah. But for sure, several of them are like, we've actually adjusted our contracts. You see that rejection rate is up still pretty significantly from a year over year.
But look at Van. Van is flattish.
It's flattish, but it's kind of dwarfed.
It's above
because of the
where
scale.
It was last year, but it's still not. It's the weak, and it tends to be the weakest of the markets.
It's the most supplied.
It is, for sure. And it's also the one with no barriers to entry. So.
Yeah. But I mean, all three of these actually have some bullish components left in them.
Okay, so can we fast forward to the rates? Because here's the dichotomy I think is incredibly interesting.
All right.
While we've seen, I want to go to flatbed rates specifically.
Oh, flatbed rates, okay.
We've seen the rejection rates are really high, but what isn't moving is the flatbed rate.
Yeah.
And I think
trending higher.
What's that?
It's trending higher.
Slightly.
Yeah.
Look over that timeline. It almost looks.
The scale makes it bad, but you know what?
But you know what I would say about that is it's because people don't anticipate this being a long-term issue.
Right.
And the fragmented nature of trucking means that not all the operators have gotten the memo that flatbed rates are on fire. So if you are a flatbed carrier, at least temporarily, you should be looking at the flatbed rejection rate. I should say temporary. Yeah. You should always look at the flatbed rejection rate, but then also be pricing in your flatbed spot loads higher than you're doing today. You can go onto Truckstop's platform. They're the leading platform for flatbed. Yeah. And when you're pricing freight, add a 50 cent or $1 a mile, and you might be surprised by what you get.
Yeah, it's definitely the most volatile sector at the moment in the truck market.
And it's positive.
Yeah.
But I think it's what we're seeing is carriers are not taking advantage of the market to the degree that they could.
For sure.
And they should be, because
it's
make money while
it's one of the hardest sectors of the truckload space to get visibility into. So
it is, but we have the data. Truckstop's platform has flatbed transit. That's where people are transacting this stuff, and
we know it's not the housing market. So let's give some time to the Q&A here. We've got about 15 minutes to go. I want to make sure we get to some of those questions. So Julia, I'll hand it to you.
Awesome. Yeah, thanks, Zach. I'm going to roll through as many questions as we can. For those of you who haven't submitted those, please do type them in your console, and we'll get into it now. This first question is from Richard, who asks, what's your opinion on which trucking sectors are likely to be hit harder than others?
I assume he means by tariffs.
Yeah.
Auto. Who wants to haul auto right now? That is the sector that I think is most exposed. Like retailers have had a year, at least since the debate, to know that this was coming.
Right.
Retailers have an enormous amount of exposure to parts of the world that are less but auto is the one that I think is most exposed, largely because it's supply chains. It's not just the end product that's the problem, it's all the component manufacturing and raw materials. And so
Also, interest rates are high.
interest rates are high. There is some, there is the problem that you get is that we're going to see higher auto prices. Even the used auto prices have shot up overnight.
Right.
There's already conversations about tightening supply in used autos. And so if you're an auto trucker, whether you're hauling finished cars or materials for auto suppliers, I would be looking to diversify my supply chain or my customer base as fast as possible, because and we've seen this. The auto market, you have these trucking companies that do an enormous amount of auto freight, publicly traded companies like PAM, mostly suppliers, they're not hauling cars. But what happens when the auto market has a downturn, when you have 50, 60, 80% of your business in auto, it kills your P&L. It absolutely destroys your business. And so I would say that if you're an auto hauler or someone that has a lot of auto exposure, I would recommend diversifying your customer base as fast as possible, just so that that if there is a substantial slowdown in auto demand.
Do you think there could be a little bit of a boost here early as people kind of go, oh, I don't want to pay the tariff price later, so I should buy one now?
The used market's already seeing it from what I've seen. Apparently, a lot of the new cars, dealers have a lot of inventory still left, and I think there could be a rush to go buy cars. But you get into the financing question, and there is a positive to this, as Trump has come out and talked about the fact that he wants auto loans to be tax deductible, and I think it's a great concept for.
Well, in America, you have
but they have to be produced in the U.S. That's the other side thing, and so I would definitely, particularly if I had international auto exposure, I think not so much you're not going to have a lot of component stuff for there, but I think I would just be very cautious.
I think there's still a risk to the retail side, especially on the discretionary, just as we wade through this as well. And that's
business
because
confidence,
economic
housing is obviously there. Agriculture, we've seen some weather issues. This has been an unusually dry season in the South. People that are hauling produce, as that starts to heat up. I
don't expect big things out of produce season this year because we're seeing, especially in California, we're seeing very depressed rates out of that space right now. It's not the time of year for it, but if you look at some of these spot rates for these produce moves, they're very depressed out of California. We've seen carriers really target California of late. If we want to pull up that chart real quick, these are produce rates and reefer tender rejection rates coming out of the Central California Valley there. Salinas, of course, becomes huge production area for a lot of our fresh fruit, vegetables and fruits, cruciferous vegetables, here in about a month and a half. Carriers are targeting California and strangely going into it with...
Well, they go to California when freight starts to dry up elsewhere.
And it's also long haul freight,
it is.
High
That's
utilization.
Why it keeps them running.
We saw last year, we got some contract rate increases. So this is definitely a sector that I don't know that we can expect big things out of produce season unless there's some sort of crazy weather event.
Great. Next question here. Will predictive AI tech have a bigger bump in Q2?
Oh, it's a great question. I think AI technology is perhaps the biggest story in our economy because of the speed at which it's being implemented. And I think what we're finding is that it really is going to impact white collar labor more so than blue collar labor. It creates efficiencies. I've certainly seen it in our business being used for different functions to help make things faster, easier to do, whether data mining, whatever. It will create efficiencies. I don't think it's a second quarter story. This is something that's going to play out over the next couple of years. But I think, I'm incredibly bullish on AI, and I also think that it will be deflationary because it will ease some of the employment demographic issues that are there, particularly in some of the white collar jobs.
Just like with any technology, everybody gets a little terrified of it initially.
Or excited about it. There's always the hype.
Yeah, but people tend to think, oh, it's going to take my job. Guess what? Computers were supposed to take our jobs years ago.
Well, it's like when Excel first came
Yeah.
out, all the accountants were worried that it was going to take their job. I've never met an accountant that doesn't use it. And I think it's true in AI, is a lot of the people whose jobs potentially could be impacted by it are going to find use of it. And we've seen just this week, like in the creative side of things, whether it's animation or graphics design, some really cool stuff that AI is able to do, the new version of ChatGPT is able to do, but that doesn't mean that creative people are necessarily going to go away.
No, not at all. AI is really bad at drawing pictures right now.
It actually, you haven't seen what's been out this week.
Oh, then I haven't.
You have got to see some of this stuff.
Well, I mean, that's the thing about it, is that it's very
happening so fast.
rapidly growing.
I mean, I've been using it for copy editing, not to write original content, but at Firecrown we've been using it to copy edit, which it does make some of that easier and faster to do. In some ways, could be argued that it's better than some of the human copy editing.
Well, it's got a consistency. Some of those systems, it works really well with. Cool.
Great. My next question here is from Bethany, who asks, there is buzz in the market that China-based manufacturers will open U.S. entities to control shipments and tap into the U.S. domestic market. Do you think this is something worth monitoring or being concerned about?
Absolutely. And I don't think I'd be concerned about it, I'd be excited about it. Like, this is already happening. We've seen, companies that are dependent upon China sourcing, including Chinese companies, but also U.S. companies, or Taiwanese Semiconductor is a good example of this. Companies that have exposure to Apple.
Right.
I think it's great. I mean, most of its manufacturing 5 years ago was done out of China. Like I think something like 60% of its manufacturing still is done in China. For all intents and purposes, it is a Chinese manufacturer. Like it is a primary part of Chinese economy in terms of manufacturing. It is moving some of the production back to the States. I think that is going to continue to play out, and I think we should be bullish on. And look, I think the broader story in 5 years, after we get through whatever this period of time would be called, I think we will look back in 5 years and we will have a manufacturing renaissance. I think that process is taking place. I think we will have an enormous amount of manufacturers that will have invested in their production plants here. It is stressful right now because it's happening. There's so much uncertainty out there. But I think you should be incredibly bullish about companies rethinking about their manufacturing and realizing the only way to insulate themselves from tariffs is to do all their sourcing here, whether you like that or not.
Yeah, I got nothing to add to that.
Awesome. My next question is from David, who asks, what type of increases should a shipper expect in the LTL sector?
None.
I agree with that.
None. Like,
not this year.
Yeah, we've got some LTL data now, some new data that's coming in, and again, it always depends on timing. We're kind of clearing that moment where we're coming through that. There were increases that occurred when Yellow exited in late 2023 that have created a little bit of an inflationary bubble that has been burst. Now, rates are not coming down dramatically from that, but they're starting to clear out. We're not seeing the level of rate increases that we saw during that period. We're actually seeing decreases off of that period in some cases, as that market has become a little bit more competitive, as people have ingested that freight into their networks. And until the truckload market tightens significantly, we're probably not going to see large amounts of GRIs. Now, the LTL sector is way less fragmented and way more pricing disciplined than the truckload space. So a standard GRI, I would expect something slightly less than a standard GRI to be sticky this year, just because we're clearing a Yellow.
If we do see in the second half of the year, if we sort of think through, okay, hopefully we'll have some resolution in the second quarter on tariffs, and we'll have some understanding, and maybe the administration will have moved on from that as the primary playbook for economic policy, and we'll move into some of the stuff that will stimulate demand, things like tax cuts, change in things like income tax for deductions, just a whole new tax bill. then I think we could see manufacturing start to accelerate in the second half of the year. That will be seeing the LTL data earlier than you'll see it in truckload, which would be something that we could see. But right now, I don't think anyone's looking at rate increases. It's an unfortunate timing also, like for a lot of carriers, because this is the time of year where these awards are coming out and these RFPs, and maybe they were hoping for 3 to 5% increases on rates. They may not get rate increases because
2 to 4 is
because shippers may be less willing to do that if they think that there's more concern about the broader economy.
I think they'll be able to get some increases just based on shipper sentiment. What we've seen, they've kind of expected. You know what? We're not as worried about transportation costs necessarily.
And is it also because the rejection rates is telling us that we're imbalanced?
There's definitely more discomfort there than they've had in the last 2 years. But LTL is a little bit different because the yellow bubble that existed. So there's a little bit more downward momentum in that space.
And a lot of the LTL carriers, where they got the surge at first, have been able to absorb. Like they've added a lot of these terminals have been added to the networks, and LTL capacity is different than truckload capacity because LTL capacity is largely dependent upon number of doors is really what drives the success in that business more so than the number of drivers that are in trucks.
For sure.
Great. My next question here is from Drew, who asks, what is your point of view on consumer financial health?
Ooh, it's a good question.
The numbers are not terrible. Like they're not bad. They're not showing like dramatic problems. I think the debt level has been a concern for a while now. We saw a pretty strong uptick in bad debt on the consumer side here in the last couple of weeks.
It also depends on which demographic you're talking about. There is a dichotomy between wealthy. The wealthiest are actually incredibly liquid.
Yeah, they're doing okay.
Have an enormous, like the wealthy are actually in a fantastic shape, even with the stock market dropping in recent weeks. The wealthy have an enormous, healthy balance sheets, and I'm talking about the upper 30% of the economy. It is the folks in the lower end, the renters. It's the renters versus buyers, or renters versus owners, I should say. People that own their own house, which tend to be older, tend to be wealthier, tend to be more established, are doing quite well in this economy.
The Gen Xers and above.
It's the millennials and the Zoomers that actually are renters that tend to be struggling more and are more prone to these issues, whether it's inflation or even these job cuts that you see in government jobs or else are also.
Is that concerning to you economically? That we're seeing a little bit of this dichotomy kind of spread?
I think what concerns me is that a lot of the economic success of the Biden administration, if you call it that, the fact that the economy, GDP stayed positive, was government printing.
Sure.
It was artificial. It wasn't real. It was basically stimulus that was coming into the economy by monetary and fiscal stimulus that was still being pumped in through all the different bills. And it was fake. It wasn't real. It wasn't additive to the overall GDP because it was just government money that was pouring into it. I think what is unfortunate is that we're now, that drunkenness that we had in just printing, the printing press is going away, and we're having to pay some pain for it. And it's unfortunate that that is happening. And so does it concern me? It concerns me how big the GDP, how big the debt is to GDP. It feels inevitable that we have to do this, but it certainly means that it is challenging.
Yeah.
Great. Well, it does look like that's all the time that we have for today. Craig and Zach, as always, thanks for being here and sharing your great input with us. Special thanks to TruckStop for partnering with us on today's State of Freight. And as always, thank you to our audience. You guys always attend every month, ask so many great questions, and make this event really exciting. So be sure to mark your calendars again for the next State of Freight taking place on Thursday, April 17th at 2 p.m. Eastern. And you can visit live.freightwaves.com for more great events like this. Thanks, everyone.